Morning, everybody. Like to welcome you all to this. It's our fourth planned Integrity 365 webinar. This morning's subject matter: are you fully auto enrolment compliant? Don't become the innocent victim. With our guest speakers, we've got Integrity 365's own senior corporate IFA consultant, Craig Pritchard. And I'm also pleased to welcome Alex Nicholl, Payroll Manager at BM Connect, who's joining us. Both got significant experience in this arena. I'm very grateful for them sparing us their time. I'm just going to wait for a few more attendees to join. I'll keep an eye on the number of participants that we've got. So as I said, it's the fourth instalment of our series of webinars. Some of you may have attended earlier ones. We've had subject matters ranging from sustainable investing through to how to maximize income through construction of portfolios. There are links to these, as there will be for this webinar in the coming days, over on our website. Alternatively, feel free to send me a message in the chat function here. I can always send links over to you. Let me introduce myself for those I've not met before. My name's Tim Jones. I'm the Sales and Development Manager at Integrity 365. So today's subject matter: auto enrolment compliance and don't become the innocent victim. Craig and Alex will run through auto enrolment, the importance of accurate payroll, especially prevalent at the moment with the pension regulator actively enforcing regulations. Just a little bit of housekeeping before we start. Nobody can see anyone else on the call. Of course, you can see myself, Craig and Alex, but you won't be able to see anyone else or hear anybody else. There is a functionality if you do want to ask any questions. If you look at the bottom of your screen and you hover a cursor over, you'll see there is a Q&A button. There's a raise your hand button. Grateful Craig and Alex have kindly agreed to answer Q&As at the end. We've already had some questions submitted from clients who sadly couldn't attend. So we've got those, but feel free to raise any questions you have either during the course of the presentation or, as I said, at the end. I'm just looking up. We've a good number. So I think without any further ado, we'll get on to the matter in hand. Craig, I'll pass over to yourself.
Great. Thank you. Thanks, Tim. Morning, everybody. Let me just share the screen. So hopefully everyone's got my screen now. So we're all good. Yeah, well, morning, everybody. Thank you for taking your time out of your busy schedules to join us this morning. Really excited to do my first Integrity 365 webinar, which is great. So yeah, as Tim explained, my role is a kind of corporate IFA. My involvement is basically helping employers and employees in relation to workplace pensions and financial well-being. So I talk pensions pretty much day in, day out. So I do generally love pensions. So I don't know what that makes me, but I want to kind of cover off three main areas today. So I want to talk around auto enrolment compliance. I want to talk around engagement of your employees around financial well-being. I want to talk around salary sacrifice, or salary exchange, as I'll refer to it today. Okay, so kind of three main areas we want to touch on. So if we can kick on. I'm not moving screens. Why is my screen not moving on? There we go. Got there in the end. So let's talk about auto enrolment. So everyone's familiar with auto enrolment. There's no doubt from a government perspective, it has been a huge success. Okay, pre-2012, when auto enrolment was introduced, take-up rates of workplace pension schemes were particularly low. So auto enrolment has been successful because we've now got over 10 million new savers saving within a workplace pension scheme. We've got over £70 billion of funds under management within a defined contribution pension, which I suspect is what you guys offer to your employees. And we've got employees typically receiving 8% of their salary going into a pension. And that's the combination of the employer and the employee. And it may not be based on their actual salary. It may be based on qualifying earnings or total pay, but broadly 8% of salary going into a pension. And what we've also got is a very good take-up rate. Very few people have opted out of auto enrolment. Kind of pre-pandemic, the opt-out rate was around about kind of 8 to 9%. But in recent figures announced by the regulator, that's kind of creeped up a little bit to 12% since the pandemic. But still, you know, 88% participation rate is way higher than the government kind of expected at the outset of auto enrolment. So, you know, really successful from the government side. But what about from your side as an employer? Clearly, it's had implications for you because you've maybe had to set up a workplace pension scheme, which you didn't have in place before. You've also got to contribute as well. So for any employee that remains within your pension scheme, you've got to contribute, I suspect, at least 3% of salary. You may be paying more than that. And you also have the additional workload that auto enrolment creates. And I put on the slide that some of you would have fine-tuned your processes. I'm sure many of you have. I'm sure there's one or two that maybe not quite have their processes 100% where they need to be. And that's what we're going to kind of talk around today. But ultimately, what's really clear is the regulator are really policing auto enrolment. They really want to protect the interests of employees in the wider population, and they want to make sure that you as an employer are meeting your duties. So don't neglect your auto enrolment duties is the heading of the slide, but that's also actually a heading of a pension regulator press release that was issued on the 26th of August, just reminding employers of their duties around auto enrolment. So it was quite timely for today's session. And as I say, the regulator kind of enforcing auto enrolment now predominantly by doing inspections. So in theory, they could knock on the door and want to really get under the bonnet of your processes to make sure you're meeting your duties. Now, probably a bit of a recap in terms of how they police auto enrolment. So generally, it comes in the form of a compliance notice as the starting point. So if the regulator becomes aware of anything you're inadvertently doing incorrectly, or if an employee whistleblows on you, for example, you will be issued with a compliance notice, which will basically say what the breach is and how and when it has to be rectified. There's some numbers in brackets here. Those are the number of compliance notices that were issued in Q4 of 2020. That's actually the last pension regulator enforcement report that's been issued. But what we can see is just over 10,300 compliance notices were issued in Q4 of last year. Now, if the regulator feels you've completed a breach or there's a breach, they will issue what's called a fixed penalty notice. So that's a one-off £400 on-the-spot penalty for you as an employer. You can see just over 8,300 fixed penalty notices were issued in Q4 of last year. So pretty significant now, bear in mind that auto enrolment has been running for a good number of years. Now, the final kind of stick that the auto enrolment pension regulator uses around auto enrolment is an escalating penalty notice. So this is if you fail to meet your obligations, they will start to incur a daily fine for every day you don't meet your requirements. Now that daily fine starts at £50 right up to £10,000 per day, depending on the size of the business. But as you can imagine, even at £50 a day, this can add up to a pretty significant fine if companies don't rectify their breach in pretty good fashion. So, and just short of 3,000 were issued in Q4 of last year. So there's the evidence there that the regulator are looking at what employers are doing. They really are on top of auto enrolment, which is very much unlike stakeholder pensions. You may remember stakeholder pensions back in 2001. There was just a requirement to offer a pension scheme, and you had to have a certificate on the wall to say, employees, there's a pension if you want it. Now, as we know, it's mandatory on you as an employer and optional on the employee. Now, as I say, the regulator are doing inspections, and I guess you could be inspected at any time. I don't know, there may be some of you on the call that may have already been inspected. And if you have, it'd be great to kind of maybe hear about that after the call in terms of how that went. But really, I think my question for you all really as an employer will be kind of how comfortable are you in your auto enrolment processes? Are you comfortable that if the regulator completed an inspection today, you'd get through that unscathed? So probably just something to kind of think about there. And what I want to do now is just talk about some of the kind of common oversights I see. So the kind of team of us at Integrity that do corporate pensions, you know, when we take a client on for the first time, what we want to do is get under the bonnet of your processes. And that's twofold, because we want to make sure what you're doing is correct. We want to protect ourselves in terms of understanding your processes. Now, undoubtedly, the kind of common oversights I come across are around three areas. But the most common, without doubt, is around statutory communications. So what we find is that companies aren't always issuing the letters that need to go to employees within the respective deadlines. So just to recap, there are kind of two key letters that you need to issue depending on how your scheme operates. So the first, if you postpone your employees or defer their enrolment for 3 months, which you're entitled to do, you have to give a postponement notice within 6 weeks of that employee joining the business. Now, That's really important you do that, because if you don't, that's an auto enrolment breach. Equally, when it gets to the end of the 3 months, or if you enroll your employees on day one, they have to be given an enrolment letter which tells them they've been enrolled, what the contributions are, how they opt out, etc. And again, that's within 6 weeks. Now, what I come across all the time, if I'm honest, is companies that say, yeah, we do defer our employees for 3 months, and we put it in the contract of employment. It says you'll be enrolled after 3 months. Well, that's not good enough. You have to give us an explicit letter that tells Craig Pritchard he's being deferred for 3 months, but most importantly, tells me that I can opt in earlier if I want to. So there's an opt-in declaration within that letter. And that's really important, because the regulator's view is, if I don't receive that letter, I was never informed I could have opted in from month one effectively. So the regulator will view that as a breach, and they will ask you as an employer to backdate membership to day one of employment. Now, in a previous role, I come across this quite frequently, and I had a number of clients where they had quite sizable payments they had to backdate to rectify this, because they had enrollers over many years that hadn't had that compliance, postponement notice. So just be really on top of your statutory communications. The other area is around kind of processing of opt-ins and opt-outs, okay? So in terms of opt-ins, to be really clear, anybody is allowed to ask to opt into your pension scheme, okay? And you must facilitate it, and you must enroll them on your respective contribution structure. So if you contribute 3%, you have to contribute the 3% and they will pay 5% or what have you. Quite often I have clients say to me, Craig, yeah, we put it in the contract that someone will be enrolled after 3 months. If someone wants to join earlier, they can, but we won't contribute. That's not an option. If Craig asks to opt in, generally I have to receive an employer contribution, just like I would if I was being enrolled on day one or month 3. So that's something you just have to make sure you process correctly. Conversely, with opt-outs, people will sometimes say to me, Craig, yeah, Joe Bloggs, he didn't want to be in the pension scheme, so we didn't enroll him. That's not the way it is. You've got to put the employee into the pension scheme and they have to opt out. Okay, yes, it might mean you deduct a contribution from their salary and it's refunded, but you've got to put them in. That's the process you have to follow. And be really clear as well. You've got to be careful in the communications you give to your employees around opting out. No problem to signpost them and tell them what they can do and how they do it, but just be careful in your language. You cannot be seen to be encouraging someone to opt out. You don't want to be seen to induce them to opt out. So just be really careful around that opt out kind of communication. And then the final area is around the payment of contributions. You know, it's imperative that your pension contributions, when you pay them to the pension provider, are invested in your employee's pension by the 22nd of the month following deduction. So if your employees are monthly paid, if you deduct from their salary in September, that money has to be invested in their pension by the 22nd of October, okay? And what you'll find is if you miss that date on odd occasions, not a problem. But if you persistently do that, the pension provider will tell the regulator. The pension provider can also write to your employees. And I had a client in a previous role, very sizable, hundreds of employees. They had a change within the payroll team. Wasn't aware around the pension process. They didn't make pension contributions for 2 months. The provider wrote to every employee to say your employer has not paid pension contributions. That created a huge amount of work, created a huge amount of mistrust between the employee and the employer, and a whole can of worms that employer didn't really want to deal with, but had to rectify. So just make sure you're on top of your payment of contributions. And what we tend to do at Integrity as part of our ongoing service is every year when we meet with you is play back the contributions that you've paid to your pension and the dates they've been paid, so we can check that you are making your payments in a timely manner. Okay, so that's some of the kind of common kind of oversights, but I also want to remind you of the basics, some of the things you just got to be doing kind of every time you kind of process payroll. And the first one is you do have a legal duty to check each time an employee is paid whether they should be in a pension scheme. So if they're not in a pension scheme, you're always checking why they're not and when they should be enrolled. So it should be that somebody is going to turn 22. It could be they hit the earnings threshold to be enrolled. It could be they hit their 3-month, postponement period. Whatever it is, you've got to be checking that cycle, that period, as to when Craig will need to be enrolled. Equally, when you're making your pension contributions to the provider, you need to make sure what you're paying across is reflective of your scheme contribution structure. So if you're paying 3%, the employee's paying 5% of basic salary, you need to ensure that 8% of basic pay is going to that pension provider. Sometimes when we do audits, the contributions are below those rates for odd employees, and that's not acceptable. They've got to be at the minimum levels. The next area, it might mean something to some of you. It may be talking like a foreign language to others, something called scheme certification, if I can say it. This is whereby you have to certify this salary definition that you're using for your pension scheme. Now, if you're using qualifying earnings, that won't apply to you. But if you use basic pay or total pay to base pension contributions, you have to do a check at least every 18 months to ensure you qualify for that salary definition, to have evidence you've done a calculation to ensure you meet that criteria. And you also have a certificate which is available for the regulator or employee to show when you did that check. So just something you need to be making sure you do, and quite commonly that one's missed. And then the kind of final one I want to touch on really is around re-enrollment. And I'm sure many of you have been through maybe 1 or 2 cycles of this now, but you've got to put employees back into the pension scheme every 3 years if they opt out. And the most important part of that as well is to make sure that you complete your re-declaration of compliance with the pension regulator. So you're telling them that, you know, they're being re-enrolled and how many people that were enrolled, and you've completed that duty. Okay, so very important. And then the record keeping. The regulator can go back 6 years in asking for evidence of action taken around auto enrolment. So they could come in and say, well, when did Craig Pritchard opt in? Or when did Craig Pritchard opt out? You need to have that record. So make sure you've got the audit in place for record keeping. Really, really important. So in terms of suggested actions, for me, it's really getting under the bonnet of your auto enrolment processes. You know, this may involve payroll, it may involve your payroll provider, your pension provider, but really understand what your process is like at this point in time. If any of you are managing auto enrolment manually, so issuing manual letters or maybe kind of manual kind of calculations, you know, I would strongly suggest you explore the options of using a payroll provider or your pension provider, because they can do a lot of the heavy lifting for you around auto enrolment. You know, seek our advice. You know, Integrity, the team here, we can do auto enrolment audits to make sure what you're doing now is compliant, but we can also give future guidance as well to make sure you continue to complete that obligation correctly. But ultimately, you want the peace of mind that your processes are compliant, but also as efficient as possible. You don't want to be spending more time on auto enrolment than you necessarily need to. Okay. Hopefully that all makes sense. I've gone through quite a lot in a short space of time, but you know, hopefully not too many cold sweats there, and hopefully things that you're all doing already. The second area I want to talk about is around kind of education and engagement of employees. Okay, you know, auto enrolment has been a success because more people are participating. Fantastic. It's probably not been a success in relation to engagement, because people don't really think anymore about how much they're paying into a pension, where their money's invested. It's just done for them. They're just put in the pension scheme. So that's a challenge. Also, you'll be very aware at the moment, it's really difficult to retain and recruit quality personnel. So you need to look after your employees. And what we're seeing is an increased kind of appetite from employers to help employees around financial well-being. And that's really to supplement maybe kind of physical and mental well-being programs that are in place. Now, this was very much on the increase prior to the pandemic. But the pandemic has just kind of increased the demand, really, because you've got people affected in different ways. So it could be employees or their households that were furloughed or made redundant, you know, so adversely affected financially. Conversely, you may have some employees now that have unexpected money because they've not been able to go on holidays or socializing, so they've become accidental savers, and they probably need a bit of help in terms of maximizing how their money is invested or working for them. So what can you do as an employer? Well, you can signpost your employees. So, you know, pension providers have tools available around pension planning and financial well-being. You can use financial websites such as PensionWise, Money Saving Experts, but also the likes of Integrity. You know, we have, you know, really good kind of workshops and clinics available, whereby we will sit with you, develop a kind of financial well-being program to kind of help your employees become better with their money, and hopefully alleviate some stress and anxiety that may be bringing to them. And it could be simple things like reviewing pension contributions or investments. It could be completely not pension related and relate purely to just budgeting, you know, making their money last them a week, a month, or how often they get paid. So just being better with their money ultimately. And what's the return on investment for you as an employer? Well, I think it's having employees that are better engaged. You know, if they're not stressed, if they're not worried about their finances, they're engaged, they're contributing to the success of the business by increased productivity. So that can only be a good thing. plus you're keeping the good people that you want to have on board within the business. The final area I want to talk on is salary exchange or salary sacrifice. It's the same thing. Many of you may be aware of it. Some of you may already be using it, but I thought it'd be timely to kind of just give you a little bit of a reminder, because lots of companies out there still don't use salary exchange, and you're missing a trick there, because it is advantageous for both the employee and the employer. So in terms of a bit of a recap, what's the benefit for employees? Well, it's a much more tax efficient way of paying into their pension. When they contribute through salary exchange, they will save national insurance contributions on their payments. As we sit here today, those national insurance rates for a basic rate taxpayer are 12%, or for a higher rate taxpayer 2%. But obviously we're waiting for an announcement today from the government around social care reforms, and it's expected that NI rates will increase, so that will enhance the benefits of salary exchange. In addition to saving national insurance, employees receive their full marginal rate of income tax relief at source. So if you're a 40 or 45% taxpayer, you will get tax relief at source, as opposed to having to claim that for your self-assessment. So it reduces administration for the employee, but it saves them money as well, which is fantastic. So simply put, it's a way of your employees reducing the cost of your employees paying into their pension. What's the benefit for you as an employer? Well, you will save employer national insurance. So currently NI rate for employer is 13.8%. So quite simply, for every £100 an employee pays into their pension, you would save £13.80. Okay, in isolation per month doesn't sound a great deal, but when you multiply that by all the people that are in your company pension scheme, and over a many year period, that creates a very significant sum of money, which I'm sure many FDs or businesses would welcome at the current time. And the good news as well is that the government kind of encouraged salary exchange. Yes, they're losing revenue in NI, but it does get people saving into a pension. And it's one of the very few benefits that remain available in the workplace via salary exchange. So, I would say kind of take advantage of it whilst we can. I want to just give you a bit of an example here. This is a case study of a company I worked with very recently in Surrey. We implemented salary exchange for them. They have 145 employees, payroll of about £4.5 million, okay? And the employees generally contribute 5% of basic salary. Now, by introducing salary exchange, it created an employer NI saving of just over £31,000 every year. Yes, there was some cost for working with Integrity to launch salary exchange in year one, but nothing like the full annual cost. And that saving is going to be year on year. And it will increase as people change their contributions, as new joiners join the business, etc. But also the benefit for the employee here is that the average salary was £31,000. They saw an increase in their take-home pay of £15.50 a month. So they've got more in their take-home pay on a monthly basis as well. So it's very advantageous. And I would encourage you, if you're not using salary exchange at the moment, just to think about what savings it could create for you as a business. So conscious of time, I've gone through a lot in pretty short period of time there. So anything that you're unsure of or want to talk in more detail, please feel free to contact me. But just to be clear, workplace pensions are here to stay. Just make sure you're compliant and not at risk of an auto enrolment breach. Just look after your employees around finances. Many will need your help. It's a great opportunity to really help them better manage their money and hopefully contribute to the success of your business. And at a time when everything is going up around us, look at ways of saving money. And salary exchange is a great way of doing that for the business and the individuals. Okay, so that's me done. I will stop sharing my screen and I will hand over to Alex. Alex, you should now have control.
Thanks very much, Craig. That was great. And thanks to everyone for attending. I'd also like to wish you all a very happy National Payroll Week. What a great time to be thinking about pensions and payroll. So I'm Alex Nicholl. I'm the Payroll Manager of BM Connect. I'm going to be talking to you about managing payroll, some of the common pitfalls, and then what it means to outsource your payroll, and also the benefits that can bring to your business. Let's start with a bit of an overview of the end-to-end payroll process. So I think it's quite good at demonstrating quite how much there is from the very beginning to the very end. I'll just pick out that I think it's really wise to not underestimate the importance of that first phase, where you are gathering all the information in order to feed it in before you even get to your payroll software and your payroll calculations. It's really important to be efficient and organised in terms of storing and gathering your data and getting the input for that period managed. So as I said, I'm really keen to just highlight a few interesting areas where there can be common oversights. There are more rules and regulations surrounding payroll than there ever have been before. It's only getting more complicated, more complex, and that obviously just means there is more risk of getting things wrong. So that's just a few items I've picked out. I could have gone on much longer list really. So just to delve into a few of them, national minimum wage compliance, I think, is a good one, because that's one that on the face of it can seem really straightforward. But in practice, a lot of businesses have found that on inspection, they have actually fallen short of compliance because of the less obvious aspects. So for example, where your employees may not have a uniform, but you have given them instructions to wear certain types of garments, certain colours, certain types of shoes, anything like that, but it's not been provided for them, then that cost to the employee does need to be taken into account when calculating their wage, their hourly rate. So if you're paying someone at the hourly rate as per minimum wage for their age, so right on that limit, but they've got these additional costs, then their effective hourly rate is actually below, and that is a breach of minimum wage. Another area of that, which has actually been in the news recently, as part of the government's naming and shaming of employers, who have been in breach of minimum wage. A case from a few years ago involving John Lewis has been highlighted, and they had an arrangement where they are smoothing out their employees' pay who are on variable hours contracts. So they're paying them the same every week, even though their hours are varying. And that's all in good faith, they say, but actually that has left them in breach of minimum wage, because in each of those periods, they need to be minimum wage compliant, not over the whole year. And so in some periods where employees have worked more hours, then you compare their actual hours to their actual wage, and that hourly rate has actually gone below minimum wage, and they are in breach. So they were liable for back pay over quite a period, and so and that's obviously that's a big case, but that's applied to I think there were 190 employers in that recent publication who were also in breach. Another one which I think a lot of people would not be aware of, number 4 there, the NI treatment of starters and leavers. So if this would apply really if a new joiner is due pay for more than one pay period in their first pay. So perhaps they've missed the cutoff and their first pay is for a month and a half of salary. In that case, you must be calculating national insurance across those 2 periods that the pay relates to. So they must be getting the benefit of the NI thresholds for the 2 periods, not just one. Otherwise, they will be overpaying NI. That is incorrect. For leavers, that would be payments after leaving. So that's when the P45 has already been produced, but some more pay is due to the employee. Hopefully a lot of people would know that the taxation there needs to be at 0T month 1, but actually there's a quite specific NI treatment as well that relates to, is driven by the nature of the payment itself and how long after the leave date is being made. So that's one that I think could easily be missed, but it's important to get right. And then number 6, not keeping proper records. So HMRC do dictate that you need full payroll records for the 3 full tax years prior to the current one, and failure to comply with that does risk fines of £3,000 plus, so very much best avoided. So this is where I see the main challenges for operating payroll in the current climate. So at the top there, I've got some key changes from recent years that cover quite a variety of areas. So I'll just ask you to look at those items and ask yourself, do you feel confident that you're dealing with those correctly? Of course, over on the right, we've got some notes on CJRS, aka furlough, which has ruled our lives in payroll for since last April. That really was an unprecedented rollout of a wide-ranging and complex scheme. You'll see those stats there. It's probably no surprise really that 5 to 10% of those who receive furlough pay were actually ineligible to do so, and that alarming figure that the scheme itself has been amended over 50 times in the not much more than a year since it started. So possibly you're thinking, well, we're nearly through it now, and we've got through it, but were there bumps along the way? And with that huge complexity to deal with, would that have been nice to have been managed by an expert team? And then technological developments. Now, I think for small and medium businesses, these are just becoming more time consuming and more costly. And a lot of companies are finding that keeping up with software upgrades is just not always manageable. That's to say nothing of the worry of data breaches and keeping compliant with GDPR regulations. So, just consider if all these costs were taken off your hands as a business, that would really clear the path for you to move forward. A case study here, which I think is very useful to highlight another couple of key areas. So this was a survey in 2019 that within small and medium businesses, 45% of employees had paid too much tax as a result of errors on their payslip. So this will be to do with either HMRC issuing an incorrect tax code, or indeed tax codes being wrongly applied by the payroll team. So, I mean, we're not going to be able to stop HMRC issuing incorrect tax codes at all. That is still going to happen. But what we can do is flag it up, give good advice to the employees, encourage them to query with HMRC where needed, and just get that resolved, for the very next pay period, rather than it dragging on for months or indeed into the next tax year. We use at BM Connect a portal called Pay Dashboard. That's for our online pay slips, and that does flag up any non-standard tax codes to the employees and encourages them to check their tax account online, look at the breakdown of where the tax codes come from, and then, if necessary, query it with HMRC, who then can turn around a correct tax code pretty quickly these days. Of course, HMRC, and of course, our team is also highly knowledgeable and experienced in terms of applying tax codes correctly in the first place. So payroll outsourcing really just means hiring a specialist team, specialist being the operative word there, to take care of any or all of those items that we've got on the left. And a good provider will tailor their services they're offering to you to your specific business needs. So you're not paying for more services than you actually need. And a big part of this is the expertise that you have on hand. Payroll might be running, smoothly and just simply for months, and then it's the unexpected events that come up that are sort of a roadblock in your path. So, maternity, jury service, attachment of earnings, these are things that you may not have encountered before. But an experienced team that you have running your payroll, that will be no issue to them. These are things that will be, have cropped up hundreds of times before, and they will have the processes and the knowledge to deal with that with no issues. Overall, the benefits of outsourcing your payroll can very much be about time. Of course, all these tasks are taken off your hands, but also the time it takes to research these more specialist areas of payroll, if you're running it yourself, that time is also taken off your hands, and it's time back to concentrate on running your core business and not getting distracted by these payroll issues. And there are absolutely cost savings to be had as well. You've just got to think about the monthly cost of your payroll software. That can be taken off your plate straight away. But then also the costs to do with training staff, if you are training staff in how to run your payroll, or indeed recruitment and salaries of hiring specialist staff as well to run your payroll. Those costs are not insignificant, and it can certainly be much more cost effective to outsource your payroll. And then, any worries about compliance and the associated fines thereof are hugely alleviated by having experts run your payroll. And as I said before, you have access to industry-leading technology and expert knowledge on hand. So if you partner with BM Connect, we are part of the Beavis Morgan Group. So you have access to all these other specialisms and departments as well that could be a real boost to your business. So within BM Connect, we have a management accounts team. Elsewhere in BM, there's the tax specialist team, so they can deal with your personal tax and tax advisory. And a big area in recent years is R&D tax relief support for businesses looking to grow and innovate, of course. And then we've got our partners at Integrity365, of course, for pensions advice. So thanks very much for listening. I hope I've covered some interesting areas there and given you some things to think about. Hopefully the benefits of outsourcing are more obvious to you now, and exactly why it could be a real benefit to your business. I'll just say that payroll is so important for any business. Getting it running smoothly and efficiently, and not having to think about it, is just time back for you to concentrate on running your business well. And when it does go wrong, that impacts on employees, and inevitably there's a knock-on effect for the business as a whole. So I'll just say, make sure you get it right. It's so important. Thanks very much. Those are my contact details, and I look forward to any questions you have afterwards. And thank you very much.
Alex, thanks very much. And Craig, thanks very much to you also. So much has been covered in such a short space of time there. So many things that have come out. Where do we start? I mean, I think we could just start with one question which came out pretty early on. Will there be a copy of this presentation made available in the future, because someone was struggling to sort of keep up and make notes? Yes, absolutely. We will make sure that there is a copy of this. We'll send a link to all the attendees so that you've got it. We've had a few questions come through as we've been going on, but one question we'll start with, which was one that came through from a client who unfortunately couldn't make it. Craig, I think it's more in relation to yourself. So with regards to salary exchange, could the government stop this being an option due to the loss of national insurance contribution revenue?
In simple terms, I guess they could. Yeah, absolutely. And I think there's always been that concern, probably for as long as I've been talking about salary exchange, which is probably kind of 15, 20 years, that could happen. But what did happen, well, probably 3 or 4 years ago now, off the top of my head, there was the government did a consultation on the use of salary exchange. And they rightly kind of identified it was probably being a little bit abused, because you could use it for tech schemes, you could use it for car parking, a whole range of areas. So they just narrowed it right down. So it was just for pensions, ultra low emission company cars, childcare schemes at the time, and cycle to work schemes. So they kind of very much narrowed it down. So very much at the moment, it's something that they absolutely endorse and are looking at. But as part of wider government reforms and tax reforms, we never know what may come down the road in the future. But my view would be kind of take advantage of it whilst it's available, and deal with the change if and when it needs to arise.
Yeah, okay. Very topical subject at the moment, of course. If an employer contributes to an employee's own pension, does the employer still have to auto-enroll at all? If not, what is the most pragmatic way for an employer to check if the employee's pension is auto-enrolment compliant? You briefly touched over that, but it's come directly from one of our attendees, so I thought it was worth facing back into that one again, Craig.
Yeah, okay. So as an employer, you have a duty to enroll eligible employees into a qualifying workplace pension scheme. Now, to be a qualifying workplace pension scheme, that scheme has to meet certain criteria. So it has to have like a minimum contribution rate, it has to have a default investment fund, but it also has to have a maximum charge of 75 basis points per annum. So there's certain criteria that needs to be met. Now, ordinarily, most personal pensioners are not qualifying workplace pension schemes. So in that respect, that employee would not be recognised as receiving a pension contribution via auto-enrolment. So you would need to enrol that employee into the pension scheme. So treat them as if they're not in a pension. They would opt out, and that company could carry on paying into the pension. You can explore the possibility as to whether that provider will allow that personal scheme plan to become a qualifying workplace pension scheme. But in my experience, that's very rare.
Okay, Craig, thanks for that. Alex, one for yourself. Would a payroll outsource provider be able to manage minimum wage compliance as part of the service?
Thanks for that question. Yeah, absolutely. I think we would certainly, how we would deal with that is we would get to know your payroll and exactly how it works as much as possible. And then make sure that basically that can all be set up within the payroll software correctly, so that any breaches are flagged automatically. And then if there are any more niche areas, as I touched on before about minimum wage, that maybe can't be set up within the software, we would just make sure those are investigated and the best guidance was given on that, so that in event of any inspections, there would be nothing to fear in that way.
Okay, thanks, Alex. Just for anyone on the call, we've had a few questions come through. Just as a reminder, if you hover your cursor over the bottom of the screen, that's where the question and answer or chat functionality is. Salary exchange is proving to be a topical point of reference, Craig, no surprise. The question, it sounds too good to be true. Any pitfalls employers need to consider?
Yeah, it's funny actually. Often when I kind of talking to employers, I kind of say that it does sound a bit too good to be true. But I guess the kind of areas you need to be careful of. You need to be really careful that it's not always beneficial for all employees. You need to be very careful around low earners. So if you've got people that are maybe part-time, it's not beneficial if their earnings are below or close to the personal allowance, which is what, £12,500 broadly at the current times. You cannot salary exchange below minimum wage threshold. So you need to be very careful for people that are paid around the minimum wage kind of rates. You need to be a little bit careful around maternity as well, because the maternity position of pension contributions is very different when you use salary exchange as opposed to non-salary exchange. So there's an ongoing pension liability when employees are on statutory maternity pay for 9 months. So employers need to be mindful of that. But that's the kind of thing we would go through the pros and the cons, I guess, as part of any kind of implementation planning process with prospective clients.
Okay, Greg, thanks for that. Alex, one for yourself. How does payroll outsourcing work with receiving employee tax code updates from HMRC?
Great question. So what would happen is the payroll provider would get registered as the agent for PAYE for the company they're running payroll for. That then allows tax codes to flow directly from HMRC into the payroll software. So there's no intervention then on the part of the company at all. That also applies to any student loans, start and stop notices, and in fact, any notifications getting sent by HMRC.
Okay, thanks for that, Alex. Craig, one for yourself. The question sort of come in, they feel it's slightly off subject, but maybe not. Some employees are expressing an interest in ESG sustainable investments. Any experience in that area from us?
Oh, yeah, right. It's a good question. I wasn't expecting that one this morning. I mean, certainly there is a massive, I would say a significant increase in ESG appetite by scheme members, but also employer level when they're looking at kind of governance. And the great thing is the pension industry is really starting to embrace ESG in terms of kind of investment options. So, you know, most providers have a range or certainly a suitable ESG fund available. I think at the end goes back to just making sure employees are kind of educated and aware of those facilities, those options, but definitely a growth area and something which is becoming more and more on the radar at employer and employee level. So yeah, absolutely. Good question, that one.
Yeah, okay. Cheers for that, Craig. I'm conscious of the time. We've hit sort of 10:45. There's still a few more questions, and if anyone's got any final ones they want to type into the chat box, question and answer box, please do. Alex, over to yourself. I think this one would be, how big are the companies that you operate payroll for? Employee number size, industry size? Someone's just trying to get a feel here.
I mean, we operate payrolls for, you know, a wide variety of sizes of companies. So right down from, you know, a whole host of companies with no more than 10 employees up to 400 and 500. And that can be, you know, salary paid or hourly paid. It's a broad range of industries up and down the country, and also for non-UK companies who are operating a UK payroll as well. So yeah, nothing's out of bounds, really.
Nothing's out of bounds. There's an invitation. Okay, this might be the final question, Craig, to yourself. Any government plans to make changes to auto enrolment, particularly in relation to the current employer and employee percentage contributions?
Yeah, interesting question. I think there's definite appetite within government and recognition that the contribution rates at the moment are not sufficient to provide a sufficient level of income in retirement. So I think it's something the government wants to change longer term. Pre-pandemic, they were very much looking at making some changes to auto enrolment. So maybe removing qualifying earnings, which basically means that full salary would be pensionable as opposed to banded income between the lower and upper earnings limit for national insurance. I think things like today's like potential announcement around kind of increase in NIs, you know, I think that all has an impact on probably the likelihood of contributions increasing, because clearly that has an impact on employers and employees' finances alike. So I think probably changes today may kick that auto enrolment changes back a little bit, but I think it's something that will come along at some point in the medium to long term.
Okay, Craig, thanks. I think that's really a really important point, that the changes that could be coming. It makes it even more important to kind of reach out and just check that the schemes are fit and proper, compliant for use. I mean, that might be the best scenario that you might find, but to check the schemes in good order, and making sure from a payroll perspective that is also, you see the options are making sure it's in good order. I think what I'd like to do is to say a huge thank you to Craig and Alex. Could be called a dry topic, but it's really, really important. And I think what has come out today loud and clear, there's been many key points for anyone on the call to reflect on. If you feel that you need any more information, you've got any other questions on reflection, just please reach out to us. Either you follow up with Craig and or Alex. You'll have their contact details, because as I said, we'll provide you with a link to the webinar. I'll just close by thanking you all for joining us and giving up some of your valuable time this morning. Enjoy the rest of your day, and hopefully see you on a future Integrity 365 webinar soon. Thanks very much. Bye-bye.